How do you build a brand new pension investment strategy with no track record at a time when markets are swinging wildly and every decision will affect members decades into the future? That's the environment Aaron Bennett stepped into when he joined the University Pension Plan as its inaugural Chief Investment Officer in September 2021. Since then, UPP's portfolio has delivered remarkable results. In 2022, during one of the most volatile market periods in recent history, the plan maintained a healthy funded status of 103.3% and outperformed the median defined benefit pension plan by roughly 3.3%. At the same time, the team built a sophisticated risk analysis framework alongside a comprehensive, integrated climate and responsible investing approach. By 2025, UPP reported a 10.3% annual net return, growing the assets to $12.8 billion. It's safe to say Aaron and his team have built and scaled a disciplined investment approach in a very short period of time. In recognition of that work, Aaron is the recipient of Markets Group's 2026 Strategy Award. Welcome to the Allocator's Playbook. My next guest is Aaron Bennett, UPP's Chief Investment Officer. Aaron, thank you so much for joining me today.
Thank you, Lauren. It's always an honor to be recognized, and this really reflects the work of our exceptional team at UPP and the support from our strong board and sponsors. From day one, the focus has been on building something durable for members, grounded in long-term thinking and disciplined risk management. I am truly proud of the progress we have made and grateful to be part of that journey.
So, Aaron, when you joined UPP, what gaps or opportunities in the pension landscape stood out to you, and how did they influence the way you shaped UPP's investment strategy?
When I joined UPP back in 2021, one of the many things that excited me about the opportunity was an opportunity to build a modern Canadian pension fund from the ground up. There was an opportunity to bring all the benefits of the Canadian pension model, recognized globally, to the university sector in a mid-sized format. The university sector is really a critical one for the future of Canada, and I think a resilient defined benefit pension can help support those organizations and people to continue to make all the great contributions they do. So we had a chance to start fresh and bring the best practices from prior experiences and add the latest thinking without the inertia you can sometimes see in more mature organizations. This means looking at what makes sense for us in terms of people and process to support what we need to do in the portfolio. From day one, we built for long-term resilience. That shaped how we diversify, how we manage liquidity, how we determine our approach to governance and risk oversight. To give you some specific examples, that range from being really selective about what we do internally versus with external partners. How do we design a private market strategy that provides the diversification we need in the portfolio at a cost and a scale that aligns with our size and our needs? And then finally, as you described, embedding climate and sustainability factors directly into our decision making because they shape long-term risk and return. Ultimately, it all comes back to ensuring our ability to provide our members with long-term pension security.
And how did the early mandate from stakeholders shape your priorities as you began both building the team and the portfolio?
The early mandate mattered a lot because it provided clarity. From our sponsors and our board, the objective was all about long-term pension security, responsible risk management, and building something that can endure. That meant our early priorities were about building the strong foundations rather than chasing any short-term return opportunities. We focused on building the right teams, putting strong governance and risk frameworks in place, and aligning the legacy plans into one coherent, cost-effective portfolio that reflects our investment philosophy and our target asset mix. That clarity really helped us stay disciplined, especially when markets were noisy, and it gave us a strong foundation that will ensure that we can deliver on our pension promise for generations of members.
Well, speaking of noise, UPP launched during a period of heightened market volatility. How did that environment influence the way you structured the initial portfolio?
It seems like a long time ago, but it wasn't. And you think about 2021, it was incredibly volatile. And it really reinforced the importance of pacing, diversification, and maintaining liquidity. We were intentional about how quickly we took on risk and how we structured our exposure across asset classes as we transitioned these legacy portfolios into UPP's target asset mix. We wanted to take advantage of the benefits of scale to get better alignment with our external partners on key areas like cost and transparency. So rather than reacting to a lot of short term market moves, we focused on stress testing our assumptions and building that overall portfolio that could hold up across a range of scenarios. The last 4.5 years have provided a fantastic opportunity to identify investments that can provide that resilience and diversification that we're looking for, such as some of our absolute return strategies, where we have seen strong, consistent positive returns throughout that entire period, no matter what interest rates or inflation was doing. In some cases, it meant that we were very selective and a little bit opportunistic about how we deployed capital, like new private equity investments. And in other areas, like infrastructure, we found a lot more opportunities that were really compelling and exciting, so we were a lot more active in making new investments. Volatility didn't change our destination of long term pension security, but it did help shape our path and reinforce the discipline early on that we brought to the implementation of our strategy.
And were there any moments when market conditions forced you to materially rethink or adjust your original assumptions?
Well, in my 25 years of experience, I've learned that markets are great at finding ways to humble you. And the way you can respond to that is to be proactively prepared, because it's incredibly difficult to reliably predict what's going to happen. Uh, we're consistently testing our assumptions related to the portfolio construction and liability modeling, regardless of the market volatility anyway. But the market's always really good at finding that extra curveball that you can't control, but perhaps you can turn that constraint into an opportunity. So, recent experience has given us multiple examples. But one example that really comes to mind is that just as we were starting to allocate to inflation linked bonds, we're an inflation index plan on a conditional basis, and that means that we really need to find ways to protect our ability to provide that benefit to our members. Inflation linked bonds are a common way of doing that. Well, the Canadian federal government decided to stop issuing those real return bonds. In the face of volatile inflation, given our benefit structure, this was a concern. That change required a reevaluation of our approach to how we reflect inflation sensitivity in the portfolio and in inflation linked bonds specifically, and some thinking about whether there needed to be other ways that we could achieve our objectives on the return or the risk management side. Ultimately, the team came up with a really creative and ingenious way to replicate return streams that we would have expected from inflation linked bonds. And our private markets team has also ramped up their activities and found some great private investments in the inflation sensitive categories like infrastructure, which can also help us on the overall return side of things.
So, as a CIO, how do you distinguish between short term market noise and long term structural risk when making allocation decisions?
Yeah. Distinguishing signal from noise is a core responsibility of what I need to do and what I expect out of my team. And that's supported by our long term perspective and the mandate that we've received from our stakeholders. However, we never ignore short-term market movements as they can often be indicators of long-term structural shifts. We rely on regular systematic review processes across different forums, including our management investment committee and the broader investment committee at the board, which help us evaluate risks and test assumptions. That's supported by an integrated risk, asset liability modeling, and responsible investment functions that can help put some of these shorter term signals into a longer term context. The diversity of experience across our management team and the members of our investment committee really helps us identify patterns where History isn't repeating itself, but it is starting to rhyme, and we should be thinking differently. That added to our culture of constructive debate also helps us to continue to test those assumptions that we make in building the portfolio. Every decision we make is again anchored in our core purpose to manage long term assets to fund members' pensions. This purpose is ultimately what helps us focus our analysis, our time, and our energy on consistently separating that signal from the short term noise.
And what role have diversification and risk management played during UPP's formative years?
It's played a very big role. Diversification and risk management have been central from the start. A key characteristic of the Canadian pension model that we're trying to replicate at a mid-size is using the benefits of scale to efficiently access different areas of diversification. This provides us with greater resilience across the portfolio, ensuring we can deliver on our pension promise through decreasing the impact of down markets and increasing our ability to benefit from long-term compounding over extended periods of time. Now, risk management and how you define risk is also critical because that informs your priorities. Early on, a major priority for us was ensuring that we could meet our pension obligations with a high degree of certainty, especially as we took on our foundational legacy portfolios. This drove an initial focus internally on liquidity and risk management. Now, liquidity is critical to ensuring that you have the flexibility to meet your obligations and to pursue opportunities without being forced into decisions by market conditions. We wanted to be able to do the right things at the right time, so we focused on liquidity and risk management, and that supported our ability to manage through this, find sources of diversification, and to really structure the portfolio in a way that it is aligned with the needs of our pension liability. This approach enables us to assess asset-specific risks through the lens of their impact on this ability to fund members' pensions and support benefits like conditional inflation indexation.
Sustainable investing is now a core pillar of UPP's strategy. How did you shape that approach and embed it into the investment process in a way that influences real decisions, not just policy, while balancing short-term returns, long-term objectives, and measurable impact?
I love this question because it allows me to talk about what responsible investing means to us. And at UPP, responsible investing is not a separate strategy. It's an important and integrated part of our investment approach to ensure that we meet our fiduciary duty to our members. For us, this is about value, not values. It's about finding a better way to capture returns and manage risk so that we can sustainably fund pensions for generations of members. Now, we integrate financially material environmental, social, and governance factors, ESG, into investment analysis, decisions, stewardship because they shape the long-term risk and return profiles of the investments we make and the portfolios we manage. This is something that I'm really excited about as an investor because while it's challenging, it has clear potential to add value to the investment process and provide us as an investment team an edge relative to the rest of the market. Integrating this gray and fuzzier data that you can sometimes get from ESG and responsible investing is something that great investors have been doing for decades. It just wasn't labeled as responsible investing. Now we have a name for it and we are using it, and it's an area that I believe will set us up strongly to continue delivering on our fiduciary duty over the long term.
I'm curious to know whether launching a new fund gave you an advantage in building sustainability directly into developing processes and structures rather than going back and having to retrofit it later.
It's an excellent point and a really insightful question because launching a new fund does present a valuable opportunity to establish those foundational elements up front. And one of the things that really drew me to the opportunity was this idea that we can think about our investment beliefs from scratch. We can think about all of our processes around making new investments and monitoring investments. And we can think about this as we recruit the team and attract those individuals to what we're trying to do as we build that team from scratch. Our investment beliefs were shaped through extensive consultation and engagement across the organization, including our trustees. Our approach acknowledges that our investments that we make on behalf of members, to some extent, influence underlying economic, environmental, and social systems that we rely on to produce the returns that we need to support our ability to pay pensions over the long term. As the plan continues to grow, these foundational beliefs will continue to influence our policies, our frameworks, and governance structure going forward. This is the kind of governance and policy elements that you don't typically have the opportunity to shape, or it's certainly a lot more challenging to introduce when you're already established. An important point here is that the fact that this is core and supported from the top down is really reflected in the people that we've been able to attract to UPP and that I have the privilege to work with. And I think that that really creates this virtuous circle of supporting all of these things for the benefit of our members.
So, what lessons have you learned about managing stakeholder expectations during periods of market volatility?
Absolutely. The volatility continues. The one thing we have to keep in mind is that we have the privilege of managing assets to fund people's retirement. Therefore, communications matters, especially during periods of market volatility, but regardless of the period you're going through. Being transparent, consistent, and focused on the long term really helps build trust. And we're in the trust business. We need that trust. It's an asset in itself that we need to invest in, and communication supports that. It reinforces why our strategy was designed the way it was and how it's performing against objectives. This is incredibly important when markets are unsettled or the headlines are particularly noisy, like we've seen in the last 4.5 years. Our members, understandably, want to know not just what's happening in the markets, but what it means for the strategy and the plan's funded status and whether our long-term objectives remain intact. Even during the pandemic, when we were all remote, when connecting with members was incredibly challenging, we made member engagement a core part of our process. We engaged with them early on to understand what matters most to them and to ensure that our team was continuously communicating information in a way that's clear, relevant, and meaningful to members. This is something that we continue to work on, and it's incredibly important in the way that we support the management of expectations and maintaining member confidence during periods of volatility, but maintaining that confidence throughout all of the market cycles.
And what metrics or signals do you pay closest attention to when assessing whether the strategy is truly succeeding or when you need to pivot?
So when I think about how do I measure success, I always go back to the purpose of the fund. The purpose of what we're doing. That's long-term resilient funding of members' pensions. So although there's no single scorecard or scoreboard or metric that really allows us to do that, I think there's a number of key ones that I think about right off the bat, like funded status. That's key. Long-term absolute performance relative to the objectives laid out by the asset liability matching, and how the portfolio behaves during periods of stress and how we can make that better. Risk-adjusted returns and resilience matter just as much as those short-term headline performance numbers. Ultimately, the success that we're trying to achieve is about delivering on the pension promise in a way that is sustainable over decades. This gives our members confidence that they can count on secure, stable income in retirement and a reassurance that risk is being taken deliberately and responsibly.
Now, looking forward, what capabilities or core investment areas will be most critical in the next phase of UPP's evolution?
As the fund grows, maintaining discipline while managing greater complexity will be key. Ensuring that we do this in a thoughtful and integrated fashion is also key to ensure that our members continue to see the benefits of scale rather than the burden of complexity. That includes continuing to invest in talent, systems, and data, as well as strengthening our risk management, governance, and asset liability modeling capabilities. Scale brings opportunities such as broader access, the opportunity to selectively internalize certain aspects of what we do, access to more sophisticated strategies, and deeper partnerships. But it also raises the bar on process and oversight. The next phase of our development is about building on the foundations with the team that we've got here and growing with purpose to support more members across the university sector and staying true to our overall purpose of long-term pension security.
And this one's on a more personal note. Are there any books or podcasts you've read or listened to recently that have changed how you think about markets or the rapid transformation happening across industries?
I'm an avid consumer of both books and podcasts, and I think there's three books I'd highlight that I think have informed what we're trying to do at UPP or informed my thinking about what's going on in the markets. What's going on in the markets right now, I think of this great book I read called Focus. It's about the ASML way. And you're thinking about this company that is really one of the only companies making machines that are absolutely required to make the computer chips that have just become the backbone of our society. Now, it was really interesting to see this long history of a company and to think about how sudden tech disruptions are actually decades in the making, and how you have to be thinking about some of these things early to really see these things coming. A second one that I've always recommended to people, particularly if they're interested in the commodity side of the business, is Merchants of Grain, a timeless view published in 1979, I believe, into the concentration mechanics of the global food commodity markets, illuminating the interconnectedness of markets and the arbitrage opportunities that emerge and the risks that can emerge when some of that interconnectedness starts to fray. And then the final one, and this was really a big element of our foundational investment belief process at UPP. It's a book called Moving Beyond Modern Portfolio Theory, and it takes a systems lens to investing, and it really highlights how portfolios can influence the broader economic, environmental, and social systems that support our ability to meet our fiduciary duty. And I found it really useful in helping to frame and describe what we're trying to do here. On podcasts, there's probably too many to mention, but I'd have to mention Don't Get Fired, How to Innovate in Pensions. It's led by a Canadian, Ashby Monk, who is at Stanford, and he offers a lot of insights through interviews with a lot of pension fund leaders around how they're future proofing their organizations and portfolios. Another great one is In Good Company with the Norges Bank CEO, one of the largest investors in the world. Unsurprisingly, he has tremendous access and incredibly candid conversations with leaders of some of the companies in his portfolio. And finally, AI is one of those areas where everyone's trying to understand it, trying to get the context and distinguish between that signal and noise. One podcast that I found really, really useful for that is Dwarkesh. It's long form, lots of technical folks on there, but he does a great job of really trying to get to the meat of the discussion in an accessible way that even someone like me, who's not an expert in AI, can use to inform what they're doing at an organizational level and at a portfolio level.
Thank you, Aaron. What a great reference list. I don't know if you noticed, but I was just scribbling some notes and making a list for my own purposes. So thank you so much again for coming on and sharing your insights. It was a pleasure speaking with you today.
A pleasure, and thanks again to the Markets Group, and appreciate the award. And of course, I'd be remiss if I didn't thank everyone involved at UPP.